called Inflation and Famine. This is the Equity Management Academy weekly podcast for April 18th, 2022. Summary. The war in Ukraine continues to put stress on global food and commodity supply chains. The mainstream media does not appear to be giving this issue enough attention. Just as supply chain issues caused by the pandemic were beginning to ease, now the war in Ukraine is causing more supply chain issues. Fundamentals. The war in Ukraine continues to put stress on global food and commodity supply chains. The mainstream media does not appear to be giving this enough attention. Zero Hedge published a report highlighted that Europe depends on Russia, Belarus, and Ukraine for energy, palladium, nickel grains, pig iron, certain types of steel, and many other commodities. Energy especially is a vulnerability as Russia now is demanding payment in rubles. Europe cannot shift to other suppliers or energy in the short term. Pig iron and other iron and steel products are also being impacted heavily. The EU also facing import issues with goods from third countries that rely on imports of raw materials from the war zone. Just as supply chain issues caused by the pandemic were beginning to ease, now the war in Ukraine is causing more supply chain issues. Trade with Russia, Ukraine, and Belarus has come to almost a complete halt with the West. Although they are not a major percentage of world trade, they are critical in certain sectors. The EU is losing exports to the war zone as well as facing import shortages. The war in Ukraine shows no end in sight, so these shortages are not going to be short-term. If Russia blockades Ukraine's access to the Black Sea, it would further impact any Ukrainian exports of grains, metals, and other commodities. China's COVID policy of locking down Shanghai is further impacting the global economy. Shanghai has a population that ranks in between Florida and Texas. It is the world's busiest port. Locking down means a small but significant chunk of the global economy is locked down. The lockdown may make the logistics issue of 2020 and 2021 look small in comparison. China's lockdown also does not appear to be shrinking. If anything, the lockdowns appear to be spreading. Recession on the horizon. In a talk recently, investment advisor Stephen Van Metre warned of a coming recession. With inflation running higher and interest rates rising, consumers are starting to pull money from banks. The Wall Street Journal warned that for the first time since World War II, bank deposits could decline. Raising interest rates could ripple through the economy in unexpected ways, such as bank deposits declining. With rising interest rates, consumers search for a better return on their savings. When banks keep savings return rates low, money moves out of banks. Some banks had been reaching regulatory limits on their capital, so the withdrawals should not hurt the banks. Banks had deposits on hand which they could not loan out. Profit margins for banks should increase as deposits decrease. One place the savings may go are money market funds, but we already have $1.7 trillion in money market funds. Money market funds may raise their rates to make them even more attractive than bank savings rates. Usually, consumers are slow to move money out of savings accounts at banks, but that could occur much faster with inflation and the Fed raising rates more rapidly. This summer, the Fed is supposed to start unwinding its balance sheets. Banks will be happy since it will release some of their capital and allow banks to persuade consumers to shift funds from saving accounts into money market accounts. Many of the money market accounts are backed by short-term treasury bills. If a flood of money enters the short-term part of the bond bill market, then short-term rates should fall, which will then drag down long-term rates. The opposite of what many believe will happen. Many markets have to invest in T-bills of less than a year, since they have to stay liquid because no one knows when the holder of the money market funds will want their money. Inflation for the nation? Question mark. The Consumer Price Index hit 8.5%, the highest since 1970s and 1980s. Higher prices and high inflation usually leads to consumer spending less, which brings both rates down. We expect the CPI to cool off. Food and energy prices are driving the CPI, with energy up 11% over the prior month, but crude oil is already coming down. Wages are not keeping up with inflation. Average hourly earnings adjusted for inflation are down minus 2.7% year over year. Consumers are not keeping up with inflation, which means less spending, which means less inflation. If banks are going to flood money market funds with money from savings accounts as investors seek higher returns, then money market funds have to buy more T-bills, which will drive short-term rates down, in turn driving inflation down and setting the stage of a recession. The markets. The key is to understand how to trade this fundamental situation. We have a lot of volatility this morning, Monday, April 18, 2022. Silver made a high of $26.49. It has then come down to $26.16 and then back up to $26.30. So we have a great deal of volatility in metals. Gold is at $18.96, but we crossed the $2,000 range. For silver, we are below the weekly variable changing price momentum indicator and standard deviation of cell 1 level of 26.28. The variable changing price momentum, or the mean, at 26.28. The signal is short unless there is a close about 26.28. The target for the weekly is 25.59. Silver is warning you to be careful up here. It is a place where the market is likely to move down in the short term. For gold, we made a high of 2003 early this morning, April 18, 2022. We are above the daily resistance level of 1896. We are also above the weekly sell 1 level of 1894. The next target is 2012. The price is entering an area of distribution of supply and support levels. When resistance is broken, it becomes support with a target of 2012. If we close below 1994, we will activate weekly and daily short triggers, a strong short signal. Bitcoin made a low of 38,535. It did not quite reach the weekly buy one level of 38,468, but found buyers at a higher level. Now we are in a bullish signal with targets of 40,330 and 40,637. Option, opinion and strategy. The 10-year Treasury is at 283, which is a significant increase over the past couple of years. The 3% yield is in the cards, Equity Management Academy CEO Patrick MontesDeOca said. The inflation rate in the U.S. is about 8.5%, and the 10-year note, even at 3%, leaves at least 5%, 5.5% negative yield. That cannot continue. At the same time, we have a $30 trillion debt. Interest rates, according to the IMF, should be about a percentage point above the inflation rate. So interest rates should be about 9 or 10%. If that happened, MontesDeOca said, the global economy would collapse. There is no doubt in my mind. End of quote. If the Fed raises rates too fast or too aggressively, they will kill the equity markets by printing money. The Fed has been protecting the equity markets. At the same time, the US dollar has significantly declined. Even though assets such as real estate have increased in price, the dollar is down about 30% in value. The increase in asset price is just reflecting the devaluation of the dollar. Gold and silver will be looked at as a safe haven asset in times like this. Continue to accumulate long-term positions.
Thank you for listening. If you want to learn more about what we do, please go to the Equity Management Academy, ematotrade.com, or listen to any of our previous episodes.
Good morning, everybody. This is Patrick MontesDeOca with Live Trading Talk here for April 20th, 2022. I wanted to share that report that was published in the Associated Press and see basically what's transpired since. If we take a look at the gold market, we're trading last at 1953, 52.90 roughly. We have activated a buy trigger from these levels. We're long at 1951. And the target is 1960 that we're looking at for the day. Now, let's take a look and see when the report was written. Basically, the market was trading at about 1794 in that vicinity. The high was 2003. And on this date, we closed below after testing the resistance levels of the distribution area of the VCPMI, and you can see a reversion unfolding from these levels. And this is the expected reversion that we were looking for. The market came in, supply came in, and now we're back down to the weekly buy one level of 1951. So it has completed basically this pattern and has gone down to the standard deviation below the mean. And it's the 2x2 standard deviation. The buy one level, which is a pivot point, identifies mathematically the probabilities that it's about a 90% probability that we could see a reversion now from here unfold back up to the mean. So we are at the support level, or the area in blue. And the algorithm is telling us here that in using the 15-minute bar at 7:15, a close above 1951 is going to activate and confirm a buy trigger. So if the signal is activated, you can use conservatively the pivot level below as your stop to get out of the market, or have a hard dollar stop based on your profile, based on your risk management and profile. Automatically, the algorithm, when the signal is activated, like here, it activates the levels above as targets for you to trade based upon your profile, if you're doing multiples, or if you're doing multiples full size or multiples micros. This is a weekly signal, so it's a pretty strong signal, and it's right underneath the daily signal in blue. And this whole area lights up in blue, as you can see, which is really the warning sign of the algorithm saying this is the area where you can expect accumulation, where you can expect buyers to come in. So the market has reverted as expected into the extreme below the mean, and pretty much we're looking at a buy one weekly level being activated. So it looks pretty good for the gold market. And we'll wait and see until the close, and the trigger points, pretty much a close above will activate this buy signal. Now, do not use straight stops. It's very important that you do not use straight stops. We don't recommend using straight stops. Stops are meant to be taken out. We have 3 levels of stops. The first one is the most conservative one, and that's a close below. The second one is a dollar stop that you can manage as a catastrophe stop. So automatically when you go into a trade, you know you have a maximum dollar stop. Never mind these short-term stops. We're going to show you how we use the stops correctly and successfully. And the third one basically is, depending upon the multiples that you want to accumulate and add to your position, if the targets below are activated. We're getting buyers here in gold, and I want to profile this signal because what I'm doing here is I'm showing you how to identify trigger points. And this is a trigger point being activated. By the price coming down into this area of support, reverting from there to close above the pivot point of, weekly pivot point of 1951, activates a buy trigger. Your entry point is 1953. If you took the conservative approach, now you can, again, do not use straight stops, but you can use the level below as your protective level, or a dollar stop, or the close of the day, if you can manage that risk. Automatically, the targets above are 1961 and 1969. So if you got in at around 1951, 53 to 1960, that's a nice day trade. And that's per contract, basically. So we have an active signal in gold. Target is 1960. Let's take a look at silver here. The silver market as well has come down into the weekly buy one level of 2506. It penetrated that level and it activated a buy trigger here after 2506. It got up to 2540, which was a nice move. It just happens on the Globex. And now we're back up. We came down to try to test this level again, and it doesn't appear that we have some buyers coming in here. So 2524 to 2506 is a pretty big risk if you want to take the risk. But it activated a buy trigger as well, and the targets are 2555 to 2559. If you're not already long. Want to take a look at Bitcoin. The Bitcoin market completed the sell one level weekly target of 42,053, as you can see here, and also activated a bearish price momentum weekly and daily, and is in this bearish pattern here. So we want to see the market trade in this area and see the supply and demand, you might say, appear, it would give us a better idea if we're getting more buyers taking out all this supply here. The expectations are that we could see this market go up to the 42,000 level, all the way up to 44,222. So continue to maintain your long positions on Bitcoin. Let's come back to the gold trade here that we have. So the beauty about the VCPMI, using it as a GPS, is basically that you have your target in place, you have the direction, the momentum direction that the market is indicating. You have your entry point, you have your protective level, you have all of the criteria that you need to be relaxed in your trade and allow for the market to come to you. There's nothing that you can do to change this setup. And so what it does emotionally is it takes out the guessing, it takes out the emotion or worrying about where the market is going. It gives you very specific criteria for you to execute mathematically, using probability models, using standard deviation and mean reversion. One of the things that I do here in the live trading room, and I want to share this with you, is besides publishing all my trades, directional or day or swing trades, I do share a great deal of data that or research that you can use to understand pretty much, what we're doing here. And you can take a look at Investopedia, mean reversion. What is mean reversion? Mean reversion is, to the mean, is a theory used in finance that suggests that asset price volatility and historical returns eventually will revert to the long run or mean or average level of the entire data set. This mean level can appear in several contexts, such as economic growth, the volatility of a stock price to earnings ratio, PE ratio, or average return of an industry. Key takeaways. Mean reversion in finance suggests that various phenomena of interest, such as asset price and volatility of returns, eventually revert to their long-term average levels. The mean reversion theory has led to many investment strategies, from stock trading techniques to option pricing models. Mean reversion trading tries to capitalize on extreme changes in price, in a particular security, assuming that it will revert to its previous state. The basic of mean reversion to the mean involves retracing a condition back to its long-run average state. The concept assumes that a level that strays far from the long-term norm or trend will again return, reverting to its understood state or secular trend. And so this is exactly what we're doing here, where we identify the market coming down below this level of 1951 to be the extreme below the mean. The mean daily is 1961. The mean weekly is 1969. This is the standard deviation extreme below the mean. And using the reversion to the mean principle, we're looking again for the price to go into this 1960-69 level. Now, as the price begins to give you a profit and move in a directional way, basically accelerating the momentum that we're looking at, then you can use a trailing stop underneath to protect your profits. And initially, you can put a stop at your entry point if you want to, be conservative and regardless continue to protect your position. Let the market come to you, and all you need to do is use the VCPMI as a GPS for your trading. Continue to hold your position in gold. We have a live signal activated. The targets are in place. So allow for the market to come to you. Thank you again, everybody, for the opportunity to share this incredible intelligence with you. And until next time, my friends, be well, take care, be safe.